Hey, it's Chris with Life 180, and today I want to talk to you about the changes in Section 7702 and how that creates both problems and opportunities when you're looking to buy whole life insurance. First of all, let's start with the opportunities. I guess there's opportunities on both sides of the spectrum. It depends on who you are. I personally believe that we live in a world right now where there's a lot of volatility. There's a lot of uncertainty. We're living in a low yield environment. And because of that low yield environment, I believe that being able to lock in guarantees in a whole life policy is absolutely extremely important. And when you look at the concept of doing infinite banking or using the and asset strategy that we talk about a lot, the bottom line is having that great guarantee is super important. Now, I know a lot of people downplay the guarantees because of the fact that dividends have been always paid out, and it's never been something you've had to lean on or rest on. But look at it this way. Right now, dividends are, being paid at 5.25 to the upper fives. And so what does that look like? Now, every whole life policy has a 4% guarantee. And if they're paying a 5.5% dividend, that means they're paying 1.5% above and beyond that 4% guarantee, right? So that's something that's important to understand. Now, what does that mean when it comes to the new Section 7702 change? That means that if the guarantee gets reduced to 2%, that is all they're required to guarantee. We don't know what's going to happen when it comes to their dividend payout and how it impacts the overall performance of the general fund for the life insurance company, right? So think about it this way. If they're still paying that just 1.5% above and beyond, now you're only going to be at 3.5%. That can be challenging. Now, that's one of the reasons why, even though everybody says, don't rest on the 4% guarantee, I think your ability to lock that 4% in, because here's the great news, is that one of the things that people don't realize is that even though this bill passed at the end of December in 2020, and it went into effect at the beginning of 2021, and it was really kind of dumped in and kind of lumped in and connected to some of the COVID stimulus stuff that was going on, the bottom line is there's a huge opportunity because there's a lot of these products that are going to be sold with the new changes, the new limitations that they're going to come with. And actually, there's some upside as well. We'll talk about that in a second. But the bottom line is that these products are still on the market in a lot of these companies, and you can still lock in that 4% guarantee because of the fact that they have to go out, they have to design these products, they have to get them approved, they got to get them to market, all these different things. So time is kind of the essence. There are some companies that are starting to roll these out, and some companies are still rocking the 4%. So that's just something to take into consideration. Now, so what are the positive changes when it comes to Section 7702? Well, the first positive change, and I think the biggest positive change that there is the fact that you could just put more money in the policy. One of the great things about them reducing the guarantees is that if you are looking to dump a lot more money into the policy and have liquidity of your money quickly, from a banking strategy, there are elements of this for people who are interested in investing in real estate, having liquidity, use, and control of their money. Even though you may not be able to get as great of a return on a guaranteed basis inside of your policy, you're going to be able to have more liquidity because you can dump more money into the policy. You can buy less insurance for the amount of money that you're able to get into that policy, which is phenomenal. That's going to reduce your costs. You're going to have liquidity of that money. You can take that money, borrow against it, and get it into real estate, get it into other vehicles, other investments. Everybody that watches me, you know that I'm a big believer your whole life insurance policy should not be looked at as an investment anyway. It should be looked at as a banking alternative, right? As a savings vehicle, a financial fortress for your money. That financial fortress, just happens to have changed a little bit with lower guarantees. The guarantees are still 20 to 25x, 30x what you're going to get in a normal bank account anyway. And so that's something to take into consideration. Now, the thing is, I want to kind of go over one thing here, and I'm gonna go to the whiteboard here. And here's the deal. This is why I think whole life insurance, regardless of the environment right now, is a great opportunity to save moving forward. Now, if you look at the last 40 years or whatever, we have 1979, and we have, I'm going to go all the way to 2009, all the way to 2021. And you can see here that from 1979 I don't know if you know this, but December 4th, 1979, federal funds rate got jacked up to 19%. That was a huge increase. It was 6% before that, right? So it went from 6% to 19%. Paul Volcker, who is a hero in my opinion, I've done some videos on this. It's amazing. He changed the world and saved the world, in my opinion, at that point in time economically by having the guts to increase the federal funds rate. That caused a lot of challenges in 1980, right? And we had a lot of crisis in the real estate market. The markets crashed, stock markets had problems. But what happened is life insurance companies benefited from this massively. So what do? The life insurance companies were able to buy 30-year treasury bonds, treasury notes that were paying them 25 or 22, 23% in some cases. And so what this looks like now is that we lived in this reducing interest rate environment until they hit zero ultimately in 2009. Now, since then, we've had QE 1, 2, and 3, right? From 2009 to 2021. And now we've had $9 trillion almost in just spending and printing because of the COVID relief bills, which is kind of insane. But here's the bottom line. This is what, if everybody who looks at illustrations for whole life insurance, they'll always say that they haven't performed to current illustrations or to the non-guaranteed column in the illustration. Well, here's the bottom line. That is the case. Why? Because the fixed market, look at this, follows interest rates. It's the federal funds rate. And we've been in this reducing interest rate environment. And so what happens is in 2009, if you go back and look through history, 2009, what happened, that's a 30-year period. That's when all these 30-year treasury bonds were dropping out of the general funds. And they stopped really boosting up the performance in these general funds. So from 2000 to 2009, there was a little drop in dividend rates. And then 2009 to 2011, 12 was a huge drop in dividend rates. And so, I mean, we're talking up until 2009, a lot of companies were still paying in the upper nines and up even double digits in some cases. And so what did they do? They dropped by 2% in 1 year for some companies. It was crazy. And so then it's been this slow trickle down to the mid fives where we are right now. And so this is what I want to tell you though, is that when you look at a properly structured whole life insurance policy right now, and you look at the 4% guarantee, well, when dividend rates are at 5.5, there's not a big gap between the 4% guarantee and the 5.5, right? So the performance is down. I actually think, even though we've had this kind of negative vibe going on about whole life insurance and not meeting the guarantees and dividend rates and so on and so forth, I'm a big believer that whole life insurance is actually going to outperform its current dividend rate scale, the current illustration assumptions. Why? Because think about it this way. We've been in this low interest rate environment for over a decade now. And while we lived, and I'm going to scroll down here, while we lived in this environment where, interest rates went down, let's say it's 2021 here, and interest rates are here, where do interest rates have to go? They're either going to remain flat, in which case I don't think dividend rates can get much lower. If they do, they only have a 1.5 down that they can go if you lock in the guarantees that I'm talking about right now, or they're going to tick up, right? They're going to start to tick up, and and they could go up. And if they go up to the 5% rate or something, then dividend rates will start to go back up. I mean, there's a lot of unknown, but the bottom line is if they stay low, they're going to reduce dividend rates. That's another reason that I would say if interest rates stay low, you're going to want to lock in the 4% guarantee. If they have a chance to go up, that guarantee is great. But either way, the dividend that they pay, the dividend scale that they pay is going to be based around the guarantee. Because remember, they're not required to pay a dividend above the guarantee. So if I have a 4% guarantee and if I have a 2% guarantee and they only are required to pay a 2% dividend above that, let's say it's a 6% dividend, they only have to pay above that. So I'm a big believer that while there is upside and while for certain people, the new rule of Section 7702, which will allow people to jam more money into the contract, that will give you more liquidity of your money potentially, that could be beneficial in an environment where you want that fast liquidity. That's another area where whole life insurance beats index universal life because you cannot get fast liquidity inside of an index universal life policy. simply because of the surrender charges that are associated with an index universal life insurance policy. So that's something to consider. And so, yeah, I mean, at the end of the day, it's just whole life insurance is the most important, I think, financial asset that people can have as the foundation of their financial life. If you look at the financial pyramid that is taught by the CFP, it is a foundational asset. Whole life insurance, properly structured whole life cash value, whole life insurance is actually one of the key liquid assets that they suggest that you have inside of your portfolio. Don't look at it as an investment, but when you look at what's going on in the world, when you look at the regulatory changes, and when you look at the opportunities for you to save for your future, I think right now is the best time to lock in that rate. Do it before the products change, because I promise you, when they change, you will probably never see that 4% guarantee ever come back again. It's been there for a long time, and it will probably cease to exist from here moving forward. So I'm a big believer, get the getting while the getting's good, because otherwise you're going to lose your shot. So anyway, I hope that helps. If you have any questions, leave them in the comments below. I love to engage with those comments. If you haven't already, I'd really love and appreciate a like on this video. If you haven't done it, please subscribe. Make sure you click that bell. That way you get notified every single time I launch a new video. I hope you found this video informational, beneficial, and you have a blessed, inspirational day. We'll talk to you in the next video. Take care.